Why are all the big finance influencers so hungry for stocks? Cum-dividend. Today, we're diving into the world of dividend payments and how they differ from interest payments. And hopefully, I won't bore you to death. We've all seen these finance gurus bragging about their dividend income portfolios. You know who they are. They talk about these payouts like some kind of magical ATM. But what if I told you there's a dirty little secret behind these high-yield dividend distributions? Not all dividends are created equal. High-yield covered call ETFs, for example, often pay a combination of ordinary and long-term capital gains. Hi everyone, welcome to my channel. My name is Simon. Today, we're diving in and cracking the code on dividend payments and how they differ from interest payments. They're not the same. There's a lot of misinformation out here, so let's try to clear things up in simple terms we can all understand. First, let's break down some terms. Pronounced like or is a Latin preposition meaning together or with, as in magna laud, with great honors. And ex means after or without. In stocks, dividend means trading with the dividend, while ex-dividend means trading without it. Anytime before the ex-dividend date, a stock is said to be trading dividend or with dividend. On the ex-dividend date, the stock trades ex-dividend, meaning the buyer is no longer entitled to the declared dividend. Those of you a bit more familiar with investing in the stock market might be asking yourselves, where is that said? I've never heard that. Well, look it up. When a dividend received is covered in cut. Where's that said? Look it up in Investopedia. That's Investopedia.com. Let's see what they have to say.
Then is the status of a security when a company is preparing to pay out a dividend at a later date. The seller of the stock then is selling the right to the share and the right to the next dividend distribution.
In order to buy a share, the buyer must complete the purchase before a certain point in the dividend period called the record date. This is associated with the next declared dividend. A declared dividend is the amount the board of directors has agreed upon, the promotion authorizing payments, blah, blah, blah. That's right.
These gurus, they're a bunch of fucking sickos. Let's talk about Bob and Alice, both with a $1 million portfolio. Alice gets 4% in dividend distributions from her S&P 500 index fund, while Bob has no dividends from his Berkshire Hathaway shares. Welcome to Portfolio Showdown. Today, we have Bob and Alice, both with $1 million investment portfolios. Alice is invested in the S&P 500 index funds, receiving a 4% dividend yield, while Bob, on the other hand, is invested in Berkshire Hathaway, which doesn't pay dividends. If Alice reinvests her $40,000 dividends, does she now have more money than Bob? Who will end up with a greater portfolio value? Let's see what happens. And the winner is neither. It's a tie. Alice's dividends come directly out of the value of her shares, not on top of them. Both Bob and Alice still have $1 million portfolios. If Alice reinvests her $40,000 dividends, her portfolio value remains $1 million. If she takes the distribution, her portfolio will drop to $960,000. And if she's going to make on average 10%, it means that on average, she should make at least $96,000 in the next year, replacing the $40,000 she took out.
Coming on down. Come on down. Go, go, go.
The ex-dividend date, on the other hand, is an investment term that refers to the trading date after which the buyer of a stock is no longer entitled to receive the declared dividend. And the ex-date is also that same one-day trading period on which the stock is listed without the value of the dividend included in the stock price. This ex-dividend period where the stock trades without the dividend is necessary because the company needs to know who to pay the dividend to, the buyer or the seller. For example, if a stock price per share is $65 and it pays a $1 dividend, on the ex-dividend date, the value of the stock would drop to $64 to reflect the price per share trading without the dividend. Dividends are not extra money earned on top of your principal, like interest on a loan or a bond. The dollar value of the dividend paid to investor comes directly out of the current share price, not in addition to it. Dividends are supposed to be the largest source of your passive income in retirement, with Social Security supposedly being your supplemental income, which is meant to supplement whatever income you have coming your way from a pension fund that you yourself have established and funded. Dividends are described as a cash payment made to shareholders as a reward for investing in a company stock. But more importantly, for us, and in practical terms, when we're in retirement or just ready to take distributions from our portfolio, dividends should be providing us with our main source of passive income, which will qualify for long-term capital gains, which is taxed at 0, 15, and 20%. Qualified dividends like those from stocks listed on the S&P 500 and the index funds and ETFs that track these indices are taxed at your long-term capital gains rate, which for most of us will be 0%. Above this amount, you'll pay 15%, and if your modified adjusted gross income is over $500,000, then you'll start to pay 20%. This is different from ordinary income, which is taxed at your marginal tax rate.
Your marginal tax bracket is determined by your total gross income, or AGI, not your net worth or assets. First, we pay taxes on our AGI, that's adjusted gross income, which we get after making necessary adjustments and subtracting the standard deduction. For single filers in 2024, the standard deduction is $14,600.
In the meantime, you can put money into a Roth IRA, and any money you put in, you can take out, so it's not locked up. If you put $7,000 in, you can take $7,000 out. If this year or next year you put in $14,000, you can take that money out. You should leave it. That's how these things work. But in the meantime, it's after-tax money, so any money you put in, you can take out. Quarterly, when your dividends are paid, that's every 3 months, the total value of your account will not increase by the amount you're being paid. In fact, it will decrease by this amount if you take the distribution and withdraw it instead of reinvesting it. This is why it's generally recommended to limit your distributions in retirement to no more than 4% of the total value of your portfolio. With the stock market growing on average 10 to 12% year over year over the course of a decade, the appreciation of your portfolio should keep up with and even exceed your 4% yearly withdrawals. Dividends are not extra money generated by your principal, like interest on a loan or a bond. They are a qualified distribution from the value of your shares, providing you with passive income in retirement without the need to sell or liquidate any asset. Many of these covered call ETFs and other investments recommended by these finance gurus might not be as beneficial as they seem. For example, if you invest in a covered call ETF or a REIT, a real estate investment trust, or even treasuries, U.S. treasuries, CDs, corporate bonds, money market accounts, you might have to pay higher taxes compared to qualified dividends from stocks. You would have to pay 10 to 15%, which is more than 0%, which is what you would be paying on qualified dividends. But the stocks will qualify and benefit from long-term capital gains without the need to sell or liquidate any assets. Let me give you an oversimplified example. Imagine you have a $1,000 bond paying 5% interest and a $1,000 stock paying a 5% dividend. The bond's value grows to $1,050, adding interest to your principal. The stock, however, pays out a $50 distribution, reducing its price to $950 if you take the dividend. Dividends aren't extra money, they're part of your principal. In summary, or TLDR, as the kids say, dividends are not money generated by your principal like the interest on a loan or a bond. They are simply a qualified distribution from the value of your shares to provide you with passive income in retirement without the need to sell or liquidate any assets. I hope I made that as simple as possible, and I hope I didn't bore you to death. See you next time. We're going to talk about dividend stripping. It's a thing.
Cum-dividend.